Hello, I'm Dick.
And I'm Eric, and we're the Annuity guys.
Everywhere you look, Eric,
High fees?
high fees.
High fees. Surrender penalties are too extreme. They're all bad for you. You know, fees are bad. We all know that fees are bad.
Depends on who you ask. Now, if you ask the insurance companies, fees are good.
No, but we always talk about surrender penalties as usually being one of the first pieces that most people look at and say, well, it's got a surrender schedule, 5, 7, 10, 12, 16, even 20 years.
And when you look at all the articles that are out there and you know, folks that really speak against annuities, that's the first thing they hit really hard is the surrender fees. And there's some good reasons why surrender fees exist.
Yeah, to take the money away from you, right, isn't it? And these are long-term products, and that's the first thing going into it you have to realize. And if you realize how an annuity is constructed and what the insurance company has to buy to hold those reserves to cover their liability of what they have to pay you.
They're purchasing bonds long-term.
Yeah.
And they want to protect their clients' interests.
Right.
So what better way, you know, to protect clients' interests than to keep all the clients from pulling all their money out at once?
Well, you can't have the annuities being churned, so to speak, you know, basically moving money in and out. And they're expecting a nice kind of slow trickle, and they're built for that. But they're not expecting kind of the giant sucking if you just didn't have any kind of...
Here today, gone tomorrow, because... there's so much that goes into planning for annuities when you're sitting down with a client to make sure that that this annuity really fits their long-term retirement goal. And Eric, my experience, you know, with clients that I've, you know, helped to set up their annuities properly is that surrender never comes into the picture unless it makes good financial sense for some reason to surrender it. That if you do your planning proper, folks look at these annuities and go, this has to work for the next 20 to 30 years, so why do I care about a 10-year surrender that I'm really never going to experience?
Well, and I think that's the key element. If it's structured properly for your situation, and this is where we talk about not putting too much into annuity. If someone takes more of your assets and leaves you with a limited liquidity, then it was probably a poor decision.
Very poor planning.
Because then you've been forced into surrendering an amount that probably didn't make sense. Now, when you're using it for retirement income planning, most of the time, if you hit that goal and you've made that achievement, you're not going to surrender this because it's your income, it's your personal pension.
Exactly.
It's going to take care of that need.
When you think in terms of financial planning and what a person is supposed to pull out of their portfolio, you know, 4% in that realm per year, an annuity allows you to pull 10% out penalty-free.
On most annuities.
On most annuities. The vast majority of annuities, 10% penalty-free. So you would actually be doing yourself a disservice if you use that full withdrawal right.
Right. You have flexibility that you don't have in a lot of other options and strategies.
Yes. So. Now let's talk about just fees in general.
Fees.
Besides,
bad. Surrender penalty bad. Fees even worse because they're going to take your money away from you.
Fees in annuities are insurance.
You're usually paying a fee for a benefit.
Exactly, it's a cost. Yeah. And so when I look at annuities, now there are different types of annuities that have different types of fees. So when I look at a variable annuity, now that gets into some high fees.
Well, it's because they have so many, and it's again, picking and choosing, you have so many different layers of fees.
Yes.
That you've got your M&E expense, mortality and...
Right, your basic infrastructure of the variable.
You've got your investment expenses.
Yes.
And then you start adding on the
different
annuity type riders where you got your guaranteed minimum death benefit or your guaranteed minimum income benefit. And each one of those can add a percentage, add another percentage.
So realistically, on a variable annuity, we're looking at somewhere between maybe 2 on the low side up to maybe 4 or 5 on the high side. Now I know there's a couple of exceptions to the rule. If you go into the Fidelity or the Vanguard, something like that, and you just get a real simple no-load, annuity, you can get less than the 2%. But you also don't get all the things that you normally get a variable annuity for.
And so we would always say that typically variable annuities tend to get the bad rap for the high fees.
Yes.
And they've earned it.
Yeah, it's justifiable.
I mean, it's unfortunate, but that's just
it's true.
Part of the what you're paying insurance on. Your unlimited upside, all that capital or working for you.
When
You
we
want-
when we switch gears
Yeah.
and we talk about the fixed indexed annuity, it's always called the hybrid annuity
Right.
out on the internet. But this type of annuity has very low fees.
Right. By comparison,
Right.
I mean, you're usually looking at less than anymore. The income rider fee, which is the reason most people want a hybrid style annuity, you're paying for that lifetime income stream without having to annuitize.
Yes.
You want that guarantee, and that's what you're paying that rider fee for, and it's usually between anymore 0.5% and 1%.
Right.
So that's becoming more and more common.
Yes.
That you'll see a rider fee on.
Well, it's a way
style.
that folks can guarantee their income. They can still have access to their principal. They don't have to give their principal up like the annuitization
Right.
method of annuities, immediate annuities.
Right.
And with that fee, they guarantee their income for the rest of their life.
Right, as long as you withdraw that rider amount, and that's what that
Yes.
that rider specifies, and it's contractually guaranteed through
Yes.
that means.
So the fees, we would have to say, as a cost for that insurance guarantee on the fixed index, the hybrid annuity, is pretty reasonable. In contrast to, say, the variable annuity and the overall expenses of the variable annuity.
Right. Now, one thing we should talk about a little bit different than fees, and that's you see because a fee comes out usually quarterly. You're going to pay it
It's
no matter
it's a
what.
set amount.
It's a set amount.
Right.
There's something called a spread.
I like a spread.
Which is a little different than fee. I actually am a big fan of the spread, and there are spread fees, really, in all honesty.
Yes.
And it's usually, you only pay the spread when there's some kind of earnings to the account.
Right,
So-
right. If you have a gain, you will pay that spread.
Right, so you're starting to see it more and more commonly, where say the first 2% are part of the spread. So if you have any earnings above 2%, you keep that, but you have to pay that 2% first. So that's more and more common, usually on the, I'll call it the indexed side of the component, more so than on the rider fees.
Yes,
So
yes.
then we also have fees for other types of benefits that we could allude to, like the long-term care. You'll see occasionally you'll have an option for a long-term care benefit that you can have as
Yes.
a rider expense.
Sometimes it's included right in the income rider.
Yes, and sometimes it's part of the overall package.
Yes, death benefit can be part of an income rider, so that can be part of a fee where you have an enhanced death benefit.
And some people have an enhanced death benefit that you pay an extra expense for. And sometimes you have a choice. You can have the death benefit or the income rider. You can't have both.
Right.
So
And you really come down to, are these fees too high? Are surrender fees too high? Or are these rider fees too high? I mean, what's the fair answer to that?
and my answer is, if it gives you the benefit that you're looking for and it meets your need, no,
It's not too high. I agree.